Well, a tip of the cap to you and welcome to the Pilot Money Guys podcast. We're recording flight 70 today. We're calling this flight, or episode as we call them, Marines Eat Glass and Love Bonds. I'm your host, wealth manager, and major airline captain Robert Eklund, call sign Rubber Mallet. Our illustrious flight crew today includes certified financial planner and former major airline pilot Charlie Mattingly, call sign The Godfather. Welcome, Godfather.
Thanks, Rob. Appreciate it, man.
And now, the moment you've all been waiting for, a very special guest on this augmented crew here today, chartered financial analyst, charter holder, co-chief investment officer, and senior portfolio manager of Victory Income Investors, which was formerly known as USAA Investments, but now a part of Victory Capital. Prior to joining Victory Capital, he was co-manager of the USAA life insurance portfolios. And before that, he held positions with Hartford Investment Management Company, as well as Barings and Cigna Investment Management. Before that, he served in the United States Marine Corps, but holds a Bachelor of Science in Economics from the United States Naval Academy, and received an MBA from the Ross School of Business at the University of Michigan in 2001. We're very pleased to welcome Mr. James Jackson, call sign James Bonds. Welcome, Mr. Bonds.
Well, thanks to both of you. Very much looking forward to our discussion today.
Excellent. We'll jump into a little aviation news here. We're recording this right after Veterans Day, so this is very sad. I'm not going to sugarcoat this one. This one was a bad one. 5 U.S. soldiers from Fort Campbell's military installation, which sits on the border of Kentucky and Tennessee at Clarksville, died during a Veterans Day weekend refueling training mission when an MH-60 Blackhawk helicopter crashed over the Mediterranean Sea. And just our hearts go out to all the friends and family of the departed here. And of course, to the 5 men who gave the ultimate sacrifice for our country. You will not be forgotten. And a salute to all our veterans out there. Thank you for your service. And Jim, thank you for your service. I know you were in the Marines there, so thank you.
Yes, appreciate it.
In other news here, we've got the long-haul carrier Emirates opens the Dubai Air Show with a $52 billion aircraft purchase from Boeing. And they basically showed the aviation industry that they'd bounce back after the groundings of the coronavirus, and as regional security is a little bit cloudy as well. Their low-cost carrier, this is kind of interesting, Charlie, their low-cost carrier, Fly Dubai, which used to be just 737s, they put an order in of 30 787-9 Dreamliners worth $11 billion. So they were changing up their matrix from all 737s to now they have 787s, which I thought was kind of interesting. But big win for the Virginia-based Boeing company on the first day of the air show, and they're poised for even more billion-dollar deals this year, it looks like. Their Emirates CEO and chairman, I'm going to butcher this, unfortunately, Sheikh Ahmed bin Saeed Al Maktoum, might have butchered that, sorry again, said the deal would see the carrier purchase 90 777 aircraft, 55 of them -9s and 35 -8s. Emirates also said they would add an additional 5 787 Dreamliners to the previous order of 30. And they said this is a long-term commitment that supports hundreds of thousands of jobs, not only at Boeing, but also throughout the global aviation supply chain. So kind of interesting there. Lots of money floating around. Any thoughts on that, Charlie? Looks like long haul's coming back.
Is it a foreshadowing of you flying the Dreamliner one day?
It probably is. Probably not me personally. No, I don't want any part of that, actually. Anyways, enough of that. Let's bring it down quick, Mr. Bonds. We've got a quick commercial. Let's bring it down a notch and get real for a second. Are you getting ready to spend some time with your family over the holidays? This is one of the reasons why money is important to you and to us, to give us time with those we love. Knowing your retirement and life goals are on track can have significant positive impacts on you, your family, and may I say the world, and we stand ready to help as fiduciaries, providing objective fee-only financial planning and investment management. If you would like some help in this facet of your life, you can reach us at leadingedgeplanning.com. Again, leadingedgeplanning.com. That's it for the advertisements. Apologies. Here we go. Mr. Bonds, James Jackson, you go by Jim. Thanks for joining us, first of all, again, and taking time out of your day. But tell us a little bit about yourself. We know you're a Marine and you're a smart guy.
Well, I'm the former. I try to pretend to be the latter, I suppose. So I'm currently the co-chief investment officer of Victory Income Investors. We are what is called an investment franchise, which there are multiple ones at Victory, Victory Capital, and we really focus exclusively on the fixed income space, and that's covering taxable bonds, tax-exempt bonds, money markets. So we are fixed income experts, and that's where our focus is. So I've been part of this team since 2009. I was hired as a senior research analyst, joined the portfolio management team in 2012. Was named head of portfolio management in 2019, and then assumed my current role at the start of this year. So prior to that, I did a couple stints at a couple different other money managers after graduating from U of M with an MBA from 1994 to 99. I served in the Marine Corps after graduating from Navy, and grew up in Martinsville, Pennsylvania. That's my 2-minute life story.
Nice. What'd you do in the
Love it.
Marine Corps, Jim?
In the Marine Corps, I was the base dispersing officer at Marine Corps Air Station Yuma for 4 years. I was the captain of the rifle and pistol team on base as well.
Neat.
And then I did that until I was discharged in May of 1999.
Oh, I love it.
Very
And
cool.
I know bonds, traditionally haven't been as sexy necessarily as equities to talk about, but I feel like lately they've been pretty darn sexy to talk about, or at least interesting. And how did you become a Marine that loves bonds?
So I'd say when I first went to Navy, I'll just dive back a little bit. Really, the only thing I ever wanted to be is I wanted to be in the Marines. That was sort of my life goal, led sort of where I wanted to go to school, what I wanted to do after that. So I originally started out as a history major at Navy. And in my first, for those that don't know, after your plebe year, your freshman year, you go on what's called a youngster cruise. I think it's changed a little bit since it's been 30 years for me. It's or over that. It's my youngster cruise was on an aircraft carrier, and we were at sea. And as a mid on an aircraft carrier, I didn't know what to do. Like, I didn't know where I was supposed to be, what I was supposed to do. There was a lot of downtime. I was looking for things to do and to read. And I happened upon a personal finance, mag, and I started to read it. I said, I didn't know anything about it. That sort of started my interest. This was something I need to learn about. So I basically spent the rest of that summer learning quite a bit about it. Went back to Navy, changed my major to economics, and I was fortunate enough to have a class where the professor said, well, we're going to do our regular stuff for the class, but everyone is going to read A Random Walk Down Wall Street. And
Yes.
so I read that book cover to cover, and that really sparked my interest. I didn't really intend to go into bonds. I think when I graduated from Michigan in 2001. Obviously, that was the throes of the tech bust. At that point, I was just really looking to find something to do in the industry, and I was hired by a firm called Signet Investment Management to do private placement debt. And really, that turned out to be extremely fortunate for me. There was very senior tenured people there, experts in the industry, and they taught me a ton, right? And I really kind of view that as not something that I necessarily didn't intend to end up there or intend to do. Private placement debt is a very niche sort of place, but I'm grateful that that's where I started, because I really got to work with some first-class people that really gave me a great start in this business.
Can you tell us a little bit about Victory Capital? We know that we're familiar with it because of USAA and
Sure.
that relationship.
So Victory Capital is a public company, trades under VCTR. There are multiple investment teams here. We call them franchises that run various types of asset classes. So you can find small cap value, things like that. So we are the fixed income team that's part of that. Our investment teams run independent, and really what we rely on Victory Capital for are basically very centralized functions, compliance, marketing, things like that. So, but we run our team. We manage our products really with very little interference. So, and that's consistent with how the firm is run, and we are certainly excited for that. We've been part of the Victory team for almost 4.5 years now, and we're certainly very excited about the growth prospects for our team.
Cool.
That's very cool.
Mhm.
I've got some Victory Capital investments with the 529 there, so I don't know if you guys touch those or not, but
We do.
probably. Yeah.
Yeah.
Fantastic. I know there's a lot of talk about bonds right now. Obviously, used to not correlate as closely with stocks, and historically, will they move again in the same direction? Hopefully not, I guess. But why own bonds at all, Jim? The softball question.
Well, I think there's basically two questions that you put in there, right? So one, the first is, what are the bonds' role in a diverse portfolio? So the first part of that is that bonds offer what is called diversification, which doesn't mean that they necessarily behave negatively to where stocks go. It just means that they're not perfectly correlated to where stocks go. So they don't move in the same direction, in the same magnitude as stocks do. So now, historically, what we've seen over the very long periods of time is that if you look at major fixed income asset classes such as treasuries, corporate bonds, munis, they're either negatively correlated, or the correlation is very low. So if you have the time period of 20 years, you roll that over and over, that is consistent over time. So the value of bonds over a long period of times we view as very strong.
Mhm.
Now, if you tighten that time period, so if you narrow it to 3 years, the correlation between stocks and bonds moves around quite a bit. So if you look at the period roughly from 2013 or so to 2022, they were pretty consistently negative during that entire time period. So that means when stocks went down, bonds went up most of the time.
Mhm.
Now, if you pull it back even further from the period, the 7 or 10 years prior to that, bonds were positively correlated to stocks, which means that they moved in the same way, right? So now, I don't think many people recall that or notice that, because if stocks are going up and bonds are going up, you don't really care so much. It's only when stocks go down that bonds go up. So now what happened in 2022 is stocks went down and bonds went down. So the negative relationship that we had seen for most of the prior 10 years basically flipped. So, we just think the one thing to remember is, over the long term, the value of bonds is, we think that the case is very strong. The value varies quite a bit when you shorten the time frame in which you look at it, right? So really, we don't think that you should not always rely on bonds moving in the opposite direction of stocks all the time. What you do see is that the magnitude at which bonds moves tends to be less, and the frequency at which bond returns are negative is much, much less.
Mhm.
So really, if you pull the curtain back, you start in 1980, and there was basically 7 time periods where the drawdown on stocks was at least 25%, right? Bonds never had a drawdown that large. There was only one drawdown in excess of 10, and that was in 2022. right? So I think it's worth thinking about. It's the point that I'm trying to make is that there's a lot of recency bias and a lot of the views on bonds is looking at 2022, terrible year for bonds, the worst year we've seen in at least 50 years. In some cases, folks are saying it's hundreds of years. So I wouldn't be colored by that. That was a very that was more of an outlier than the rule, right? So with that background, why should you hold bonds? I think the role of bonds in a portfolio does a couple of things. One, we think is it does provide a counterweight to stocks, really will help mitigate the risk of portfolio drawdown. We think that especially now, bonds generate income. There was a long period of time where there was not a lot of income in fixed income, right? So there's very much higher levels of income now. And you can also manage your bond exposure to help preserve capital. And really what I mean by that is that if you look back really over the big drawdowns in stocks over time, bonds really provide support to the overall portfolio in the periods when you need it most. And I would stress certainly that 2022 was an outlier there. But if you look over a broad scope of time, we think that the value of bonds has held up pretty strong.
Yeah. Hey, Jim, you hit a lot of good stuff there. And, 2022 is just, like you said, it's hard to express how deep of a downturn that was for bonds, how much of an exception that is to the general rule. And so that's pretty unprecedented. A couple of questions there I'll throw out to you is, should we have seen that coming, or was that was kind of like to me, it seemed like a perfect storm where we anticipated rates going up since about 2009. It never happened. It never happened, never happened. And then bam, it happened almost instantaneously, relatively speaking. Maybe COVID had something to do with that, maybe prior policy. So that's kind of that first question. And I'll let you go with that one. That's a lot, I know, but you don't have to spend a ton of time there, but I'm just curious as to what your thoughts are on that.
Well, I would start with, if there's the financial industry in general does a terrible job of predicting, right? So ourselves included. So it's not something that we do. We don't think it's a reliable way to generate returns. I'll even pull the curtain back further, Charlie. I remember in 2003-4 timeframe when the Fed funds rate was at 1%, and rates are never going back up again, or never doing, and then so I think that this narrative has been around for quite a long period of time. I think there are some specific risk factors when rates are really low, in that if there is an increase in rates, the yield that is generated when rates are low provides minimal cushion to the price decline that you see when rates go up, right? So I don't necessarily think there was a way to foresee this or predict it. So I kind of look back and say, well, if that was the case, why wasn't everyone in money markets at the end of 2021? Well, they weren't, right? So I think it's just I don't spend a lot of time thinking about we should have predicted this or not. I spend all my time knowing that we can't predict where things are going to go, and knowing that just running the process that we have to generate strong returns for our clients based on things that we do know.
Yeah. It's always a matter of like hindsight seems so clear, but it blows me away when I look into it at how complex all these things are that go into, the yield or the price of a bond. I mean, it's a lot of varying factors, and a lot of them are behavioral factors that we can't possibly predict, I believe, as well. As far as when I say behavior, I just mean, inflation or the consumer behavior that drives Fed policy. So
sure. I would go so far as to posit that the primary risks in any portfolio right now are things that we're not discussing and that we don't even know what they are. So if we look back, so if you would have asked us 5 years ago, what's the biggest risk to your portfolio, I would hazard a guess that no one said a worldwide pandemic, a shutdown in the economy, global supply chains coming up, inflation going higher, and a spike in interest rates. I would doubt that very few people had that on their bingo.
Yeah. And the other question is, you talked about how bonds are valuable because, well, now they have income, which is phenomenal. We haven't had income on bonds in years.
Sure.
But, the majority of our clients are pre-retirement. We do have a lot in retirement, of course, but a lot of our pre-retirement clients are like, I don't want to own them. They're down. I can see it on my statement. But like you said, they minimize the drawdown and the ballast. We always use that term, the ballast. But can you explain maybe simply, like, how does it minimize, the drawdown? I mean, and I know you could get into some equations there if you wanted to, but what does that look like? Can you explain that?
Sure. Well, I think, and broadly, I would look back to if you have a portfolio. So if you're near retirement or early, one of the big risks you have is that there is a material drawdown in your portfolio at the same time you're withdrawing money from it, right? So if you have a drawdown like we saw in 2009, right at the time you retire and you're taking out 2, 3, 4%, that is a distinct risk for you, and you're going to want to look to minimize the level of drawdown that you have, right? And bonds help you do that, right? I think that over time, what we've seen is that when there are significant equity drawdowns, that bonds help mitigate that risk. So if we really look over the last 50 years, let's just go my entire lifespan, right? There have been 11 years when equity returns were negative. In 10 of those negative return years, Treasury bonds had positive returns. In 8 of those years, corporate bonds had positive returns, with 2 of the negative returns only being in the low single digits, right? So really, that to me is further evidence that 2022 is an outlier, and that you can use bonds to protect yourself, particularly when you're about to retire or early in retirement, when the risk of an equity drawdown is highest for you because you're just starting to take money out of it. And that's sort of my own view on it, right? And so that's sort of looking at the long span, not even really thinking about how bonds work, but sort of how they behaved over long periods of time.
I think that's so important, especially for our clients out there in their 50s, getting close to retirement, potentially in the airline world or getting closer, is that sequence of return risk that we kind of foot stomp so much with clients. Is how do we mitigate some of that? And bonds are fantastic for that.
So when you have a bond that's yielding 1%, and say the duration of that bond is 5, which is a sort of measure of interest rate risk, and rates go up 1%, that bond price is down 5%, and the income to overcome that is only 1, right? So so there's not much cushion there. Well, now that has sort of been flipped on its head, where yields are 5 or 6%. So that same 1% increase in rates and 5% decline in price within the next year is overcome by the amount of yield sort of generated, right? So even though bond returns, this is we're in the midst of the 3rd consecutive negative return year for the Bloomberg aggregate, which is the major bond index that's used. Well, that's being driven by, because we started at a very, very low yield, near all-time low yields, and they had an unprecedented increase in interest rates driving that price down with little yield support to cushion that, right? Well, now that has kind of flipped somewhat, and that the yields are much, much higher. And really, just to think about how unprecedented it is to have 3 consecutive years of negative returns in fixed income. You really have to go back to the start of the ag in 1976 through the end of 2021. In that entire time span, there were only 3 negative return years in fixed income during that entire time period, right?
Mm-hmm.
So we've had that in the last 3 years, right? So I would caution against sort of the recency bias. The compensation of whole bonds in the form of yield is an order of magnitude higher than it was at the end of 2021. And that bonds are all about math, right? So that certainly changes it going forward, and that the yield at which you buy a bond is highly explanatory with regards to the annualized return over that bond during, the life of the bond, right? So unlike stocks where the PE can change it around quite a bit, over the life of a bond, it has a defined term, and the yield at which you buy it has a very high level of explanatory value for the return on that bond over the life of the bond.
Mm-hmm. Yeah, I'm tracking. I'm trying to follow along. It's very, some of the concepts are hard, like
Sure.
interest rates go up, prices go down. And what you just said there is really important. So I would advise everyone to rewind, pause, listen again. But what you said is so true, that bonds in a way are simpler than stocks because it's math, and I think right now the math would agree that it's a good time to own bonds especially if you are at or near retirement, because of that yield, because of the, just the benefits it provides, not just in your portfolio, but just frankly, the income, right? I mean, is that the future is bright, I guess, as I'm trying to say. That's what the math shows.
Well, on an absolute level, it sure does, right? So the yields that are on the major fixed income asset classes, the yields are the highest they've been in 10 to 15 years, sometimes even longer than that. And that starting yield, like I said, is very important as far as explaining what the prospective returns, annualized returns over the life of the bond are expected to be. And also what we're seeing now too, which we haven't seen since probably 2007 or so, is the real yields are positive as well. So after the GFC in 2008, 2009, Fed was holding rates very, very low. I think everyone knows that they were held close to zero for an extended period of time. And what I mean by the real yield being positive is that the current real yield on 10-year treasury bonds is in excess of the inflation rate, right? So that's a positive thing as well. And also really how much the environment has changed is when you look at 10-year treasury bonds, the yield on 10-year treasury bonds compared to the dividend yield on the S&P 500 is as positive as it's been since 2013. So that relationship varies quite a bit over time. Sometimes it's positive, sometimes it is negative, but where it sits right now, basically over the last, recent months and quarters, is really at such a positive, the most positive that we have seen it since at least 2013. So there are multiple indicators that we think are saying that bonds are attractive on an absolute basis, and also relative to stocks basis as well.
All right. Go back and listen to our, for our listeners, not obviously you, Mr. Bonds, but we got Flight 53. We actually named Bonds Are Sexy again, and so is Giving. So give that a shot. And then also our listeners hopefully are familiar with that bond seesaw, if you will, Flight 55 we also talked about because of the bank and the banking crisis that happened. So I just threw that in there, Charlie.
Absolutely. Yeah, I'm trying. My whole mission here, Jim, is I got a Navy buddy of mine, Mark. I told Mark, I said, Mark, we're going to convince you that bonds are good. He's not a believer, but I got to explain the math better. And so there's a lot to benefit there. Like you said, especially for the at or near retirees or in retirees, the sequence of return risk, another math problem, if you will. If you're pulling money out of your portfolio and it's down, then the math simply is really hard to overcome and can be detrimental to your portfolio. So we've talked about that before as well. The other thing I think, Jim, maybe you can talk to is a lot of people right now are like, why would I own anything but a 1-year treasury? I'm getting 5% and it's guaranteed. It's such a comforting factor to see that known quantity, but but now, and maybe there's some relationships that are similar to like owning stock. So how do we convince people like, hey, we know you can get this guaranteed 5% for 1 year in a treasury bill, but we think you should have a more intermediate term bond that's kind of down right now, but it's better. That's a tough conversation.
Sure. This
Yeah.
is probably the most common question I get, or one of them, right? And I think really it's and I think I'll start with, and this is a common term. I think this has been said quite a bit, is that really the only free lunch in finance is diversification. So if you think about concentrating your holdings in like a T-bills or money market fund, that invites several risks of its own. It has the comfort of you're going to get your par back, which means that when the bond matures, you're going to get all of your money back, or with a money market fund, the NAV is one, right? That's what you're going to get back, but it invites several other risks, right? The first is reinvestment risk. What this means is that you may be getting 5% now, but when that bond rolls over, rates may be lower, they may be higher, but certainly you have a risk that you're not going to generate the same level of income that you can now, right? So as we said before, I think the one thing that the market has been terrible at is predicting where rates are going to go, right? So I'll just provide an example of that, is that if you looked at the end of 2021, there's a market pricing mechanism that basically prices in what the federal funds rate, which is the rate that the Fed sets, is going to be. So there's a bunch of market players that will price in price what the Fed funds rate is going to be, whether it's 6 months or a year from now or whatever. Well, at the end of 2021, the market was still pricing in a Fed funds rate of less than 1% at the end of 2022. Well, they missed a mark by hundreds of basis points, right? So that is the biggest players in the space with money on the line looking to place a market position to benefit from where they think rates are going to be. And they spectacularly got it wrong. So I just use that as evidence that trying to make a prediction, but you are making a market timing call. And also when you look at how those bonds return after the Fed is done raising rates, so you may think they're probably done or close to done. But if you look at the returns over 1 and 3 year time periods, over the last 4 times the Fed has stopped hiking rates, cash underperforms short-term bonds, which underperforms intermediate-term bonds, right? So I think those things are worth keeping in mind if you're hiding out in cash because you think rates are going to continue to go up. I would, as I do with all macro forecasts, I would give them with sort of a great degree of humble pie.
Yeah. I think there's two. It's just confusing to look at a statement and see that, my aggregate bond fund or whatever is down, and here's this treasury bill that's guaranteed. I can see that interest. And I think, Jim, part of that is that when I look at that bond fund, I'm seeing the price impact in there and not just the yield, because the yield now on a aggregate bond fund is pretty healthy as well. But on my statement, I see that price fluctuation, and that's confusing to me as an investor when I don't see that on a treasury bill. Is that kind of make sense the way I framed that?
Yes. Well, I think even a treasury bill, the price will move, between the time you buy it and the time that you get your par back. So I think sometimes just buying an individual treasury bill or bond with the idea that, hey, in 1 year or 2 years or 3 years or 10 years, I'm going to get the par amount back. The price is moving during that time period. So I think it's provides some level of comfort in that is what is going to happen. But I would view that as more sort of optical than what is actually happening with the bond pricing, which those bond prices are moving around as well. And if you had to sell it during that time period, you would sort of either benefit or gain depending on what rates have done.
I've got an off-script question that has been bugging me, and I love to pick Mr. Bond's brain on this one, but I've heard that potentially bonds could help in a crisis alpha, or to gain crisis alpha and outperforming?
So I would start with this is my view, right? In that my view only is that the best crisis alpha that any investor could have is having a investment plan that they believe in, that meets their risk tolerance, and that most importantly, they can stick with through time. Right. I think that the real crisis alpha is not exiting your portfolio at the worst possible time. And I think it was Charlie Munger who said, no, I'm not getting this exactly right, but it's like the best thing about compounding interest is not interrupting it or something, right? It's just to keep. So I think that there's having that understanding and buy-in that your investment strategy is right for you, so that you can stick with it through time, even when things look bleak. That the real crisis alpha comes from that.
Now, we couldn't have said that better ourselves, I don't think. And we just quoted that same thing on the last episode. Don't interrupt compounding unnecessarily. I love it.
Well, and it's and as far as bonds go, right? I think that there's I think to the extent that there is an economic crisis, and we'll just use 2008 to 2009 as an example. So you saw treasury bonds perform really well during that time period. You saw the ag do decently well too, right? Because like 70% of the ag is agency bonds and treasury bonds, right? So I think as far as when the equity market is extremely challenged and there is very much a risk-off trade, back in 2008 and 2009, I think this still stands, is that the flight is the treasury bonds. And so I even think as a small example of that is October 7th and 8th, when Gaza or when Hamas invaded southern Israel, there was treasury bonds dropped 30 basis points like the next day, right, in the 10-year part of the curve. Well, that didn't happen because there was some magical change in what the Fed is going to do or what Congress is going to do with fiscal spending. It was basically a momentary risk-off trade. No one knew what was happening, and the at least that's my view as far as what had happened. So I think that sort of insurance is important. At least I think it is, and I think what it allows you to do is to stick with your plan through time, because you have some things that in your portfolio that are holding up better than others, right? So I think that the challenge that some, at least that investors who are taking a lot of risk by holding a lot of stocks. So over time, that's going to work out well for them. But the point is, over time, right? It means they need to stick with that over time and hold enough safer type assets to ensure that they can hold those types of assets that will have a larger drawdown over longer periods of time.
I love it. And even, even in my own portfolio, Charlie knows this as my financial advisor, but it's nice to have those bonds there, maybe hopefully performing, differently than the equities when they go down. I have that little bit of bond buildup where I can sell those and buy some more equities at lower prices. It's fantastic.
Sure.
Yeah. Jim, I think it's fascinating. Here you are in the business of building bond portfolios, and, you're a CFA, which is a highly sought after, very, very challenging certification to get. But anyway, it's funny because a lot of people, I think we watch the news, we see all these talking heads, and there's predictions, and there's this image of magic solutions that only they know. And that's just not the case. A lot of times we'll get a question from a client that says, hey, what are the big institutions or the really wealthy people? What are they doing? And, as if it's, again, as if there's some hidden potion or silver bullet. And it's interesting to hear you a person that's on the front lines of that world and saying, hey, look, we don't have to predict, we have to plan. Diversification is the only free lunch, all these back to basics principles. And so I think that's pretty phenomenal, especially hearing it coming from you, because we say that all the time. And in fact, earlier you talked and it surprised me a little bit. You said, we don't use those types of tools at all in building bond portfolios. There's not even an attempt to try to predict something, I guess. Is that true? No attempt whatsoever to kind of foresee when you're building a bond portfolio.
For us, that is true, right?
Yeah.
So we kind of, if I think about how we manage fixed income, I'd say there's three things that we know, right? Or at least that historically has proven it, has convinced us that we know it. One is that the yield at which you buy a bond is highly explanatory to your annualized return over the life of that bond. We have studied that, others have as well. So that's something that we think we know. The other thing that we think we know is that by taking some level of credit risk, meaning buying corporate bonds, asset-backed munis, that you are compensated for that incremental credit risk over time. So in the interim period, they can move around quite a bit, but over time, you are, at least we think, are compensated for that risk. And the third thing is that interest rates are not predictable. So when we build our portfolios, we're building them with those very foundational principles in mind, right? So when you look across our product set, basically, if you're buying an intermediate core portfolio from us, the level of interest rate risk that you take is narrowed within is managed within a very narrow band around its benchmark. So we're not trying to generate returns relative to the benchmark by taking bets on interest rates, right? So some of our peers certainly do that, but we're really focused on delivering the level of interest rate risk to the client that's embedded in the product, looking to use our very fundamental research process to add incremental yield, which we view as generating returns over time. So that's just kind of our view of it. I kind of like to think of it as that we know what we know, right? But we also are very cognizant of what we don't know and looking to sort of mitigate those risks when we're managing our bond funds.
I love it. Just a quick note here. I know I'm bragging to you to your face here, Mr. Bonds, but for those of you who don't know, a chartered financial analyst charter holder is considered a highly distinguished profession in the world of finance and possesses a deep understanding of investment management and financial analysis. If you couldn't tell that already, I think you might need to rewind it a couple of times, but that's pretty evident. But I just wanted to throw that out there because you hold that credential, which is fantastic. And, Charlie and I are sitting here gaining as much as some of our audience sometimes with some of your quotes. So thank you so much for that. Charlie, got anything else that you want to hit on?
That's been awesome. That's a lot of great information, Jim. We appreciate it, man. And I'm going to have to go back and review our notes and listen to this one again myself.
I thought that when you covered the three, I was trying to write fast and I couldn't get the first one, but I was like, I'm going to rewind this. So that's fantastic. Jim, anything else you want to cover before we head off here?
No, I think that was great. Thank you for the time. It was a great time talking bonds with both of you, and hopefully this was worthwhile for everybody.
Yeah, absolutely. No, thank you so much. Appreciate your time, and a couple of bond quotes for you to ponder on your drive or flight or commute or daily ritual, whatever. Martini shaken, not stirred. And that's obviously from James Bond. I was trying to look for Bond quotes here, and I could not find many Bond quotes. Of course, the other one's from Thunderball. Oh, I travel, a sort of licensed troubleshooter. I was going to try it in the Sean Connery voice, but I decided not to do that. So this one's from George Soros. If investing is entertaining, if you're having fun, you're probably not making money. Good investing is boring. And the last one's from John Bogle. If you have trouble imagining a 20% loss in the stock market, you shouldn't be in stocks. That's it. That's all we got. Let's be the first to welcome you to the final destination of Flight 70. Marines eat glass and love bonds. We didn't even get to the eat glass part, but I imagine you have to do that to be a Marine. You guys are tough as nails.
I have never eaten glass, and I would not recommend
No
it.
recommend. Oh, that's great. If you don't mind, do us a favor, hit that subscribe button, leave us a review. We aim to help people be better with their money and the things that come with it. Help us by leaving us a rating. Please shoot us any questions you'd like us to cover. And remember, as Emerson said, the world makes way for those who know where they're going. And as we say, so plan accordingly. From all of us at the Pilot Money Guys, we wish you smooth rides and soft in the zone landings. Bye-bye for now.